The silver market is fast approaching breaking point. Martin North, John Adams, in the interest of the people. Hello, John. How are you doing?
Good, sir. How are you going today?
Yeah, I'm pretty good. Nice to catch up once again. And we're going to explore the silver market in a bit more detail, aren't we?
Indeed. So a couple of weeks ago, Martin, we did a show called George Soros and the Silver Moonshot. And in that show, we said to the audience that there's a lot of interest in the silver market because of the silver squeeze movement. And we were going to do a couple of shows about it. So the last show in which we did, I talked about an article I wrote last year about how I view the market structure. And that market structure is a price ceiling below equilibrium. And we compared that to what George Soros did in 1992 in a similar circumstance when he was able to break the Bank of England. Now, in today's episode, we're going to actually go through some actual detail of what this silver squeeze is all about. Now, one of the points that I've made, and you've made, not just about silver, but for commodities and financial products in general, is that there is a one-to-many relationship. And that one-to-many relationship between physical ounces of silver versus paper contracts, that is the mechanism in which market manipulation, that is how it occurs. And so when you have a situation where you get a crisis point in a market where there is so much paper contracts versus the underlying physical, that those counterparties who have to come up with the physical can't come up with it, that's when you have a breaking point in the market. And that's when the market starts to go ballistic in terms of the price. And so in the last few years, one example of this could be the palladium market. So the number of short contracts on the COMEX futures market for palladium was quite high, and there wasn't enough physical ounces of palladium to meet the demand deliveries. It reached a point at which the market broke, and then the price went up 400%. And so there's quite a few YouTube channels around the world who are now talking openly about the silver squeeze. And the silver squeeze is effectively this possibility that enough physical demand can basically lead to a crisis point in which those who have to deliver physical silver at the COMEX in this COMEX future delivery contracts can't come up with enough physical silver. And the only way that can be resolved is either a default or the price has to go up quite aggressively so that you can attract supply to get the physical silver to then meet your contractual obligations. So that effectively is what the silver squeeze is about. The movement started in late January after the first phase of the GameStop phenomena came to a screeching halt. And just on GameStop, I don't know if you have any observations, but it's interesting that from I think early January to late January, the price went up about 16, 17 times, up to $483 a share. Then it went through the floor, and now it's gone back up again.
Well, just generally, John, there's a couple of points to make, I think. This concept of the relationship between the underlying and all the derivatives is fundamental to understand, right? And it's worth also highlighting that quite often people will never hold physical, right? They will always close out before contracts are due. And it's the movement in price at 2 points that allows them to make money in the process, right? Of course, for everyone that wins, somebody else must have lost, right? Yeah. But what it means is that there's a physical possibility to make significant amounts. And in fact, you want volatility, which takes me directly to GameStop. GameStop was about volatility, and it was about basically the hedge funds on one side of the equation and the so-called small traders on the other side, although actually now the intelligence is that there were some hedgers on the other side too who were playing off against the other hedgers. And that's the other point I want to make. This is a good example of the dynamics that happens within financial markets, where effectively you have people betting on what other people are doing and traders watching what other people are doing and taking deliberately contrary positions to be able to try and maximize the returns. That is at the heart of trading across pretty much all asset categories, including, I would suggest, silver.
Sure. One point I just want to make before we get into what's been happening over the last 5 or 6 weeks in the silver market is, this one-to-many relationship is so extreme in the silver market that it's created a very unique paradox. And I've done a number of interviews today, and I've been, with a number of American channels, and I've been actually asking my American colleagues, an economic question, and I said that microeconomics can't actually help explain what's going on. So just to, we've touched on this in the previous show, but just to recap. So I went up to the RBA website last night, looked up the definition of the money supply, looked up broad money, and what we can tell is from January 1980 to January 2021, basically 41 years, we can see that the growth in the money supply is 2,968%. And yet there is only one price of a good or a service which is still in demand, which is lower than the 1980 price. And that price is silver. So when you look at cars or clothes or houses, land, financial assets, whatever the case may be, holidays, etc., every price is higher than 1980 except for silver. Now, the only way from a microeconomic point of view that could be remotely true is that if the above ground stockpile of silver, if that's grown faster than the growth of the money supply, assuming demand is constant, then that can be a plausible explanation as to how the price in 2021 is lower than in terms of 1980. And yet, I wrote an article a couple of years ago citing a number of American sources, and what we can tell is that in rough terms, the growth of the above ground stockpile of silver has probably grown about 100%, or maybe slightly over 100% in 40 years. And yet the growth of the money supply has grown by 3,000%. So that's why even with gold is at a price now which is much higher than what it reached in 1980 or in the last bull market in 2011. But for somehow, silver is a unique property. And so now, I know, Martin, you studied philosophy at Oxford. I did study economics at UNSW as well as at the University of Wollongong. My training at the university level doesn't explain this paradox. And as I've been being interviewed by a number of American YouTube channels, and some of those people have been trained in economics in America, I sort of said, well, is there a plausible microeconomic explanation for how this statistical anomaly could be produced? And I was just on the channel with Chris Marcus on Arcadia Economics, and he said there's only one plausible scenario, and he brings up a court transcript from UBS in which they openly admit in chat groups that they are smashing the price of silver. So it could be UBS, it could be other banks manipulating the market, but Martin, if you have a rational macroeconomic theory to explain this statistical anomaly, I'm all ears to your explanation.
Well, John, I think I'd come back the other way to say my study of financial markets over 30 years, and I've taught financial markets in all sorts of contexts too, has revealed more and more that most of the markets are rigged. It's just a question of how much is rigged and who's winners and who's losers. So I don't think that silver is a uniquely rigged, although that multiple, if it's right, and by the way, it's very hard sometimes to really understand how much multiples there really are, because of course there are various forms of derivatives from futures and options and calls on futures and options, and even taking not physical delivery but effectively shadow tracking the price, and all those things are happening, right, in pretty much all of them, all of the financial sectors. So my theory is, John, all financial markets are rigged. Some are rigged more than others, and the fact that the data suggests, as you show, that the real value of silver is lower than pretty much every other asset suggests that there is something serious going on. I guess that turns the question on its head and says, well, okay, but is that likely to stop? And I guess that comes back to, well, so who's doing it, why they're doing it, and are they likely to change their tune, either because they can no longer continue to do it or because they fundamentally change philosophically what they want to achieve. And I guess those are the really interesting questions. I think I should also make the point, John, of course, people will say, oh, you're a silver Spruker because you're actually aligned to a silver company. I would just underscore that you've said a few times, and I'll say it for you, you can say it again, is you are following your instincts and analysis, and the silver thing came second once you started thinking about it, right?
Yes. So I have been working with a bullion dealership since mid 2018 when I first met you, Martin. And the silver story, I first became aware of it, and the statistical anomaly was probably about 2016. And I started buying in 2017, and I thought to myself, well, I want to get more involved in this industry, and that's where I sort of went and became a chief economist down in terms of South Australia. Unlike, for example, so you and I in the past have criticized real estate agents who have a long-term career in spruiking a particular product. For me, I don't have to be doing what I'm doing today. I don't have to work for a bullion dealership. I could easily quit and go off and do something else. And I've had a very interesting and diverse career. But no, look, to me, there's something very unique happening here in this market, and I wanted to get more involved and work in the industry, and here I am. So definitely for me, it's always the analysis follows. With the analysis comes first. And then if I have any commercial interest, then that is secondary to the analysis, because at the end of the day, I'm heavily invested in the silver market. And if I'm wrong, me and my family stand to lose a lot of money.
Are a bit like Harry Dent and his limo driving up in the Gold Coast, right?
Indeed, sure. So now, I'll look. What two things, Martin? First thing I want to do is that in the last few weeks on my website, adamseconomics.com, I've published two very lengthy articles, about 3,000 words each, about the silver market, and people can go and have a read of those articles. And Martin, I'm sure you put them on the screen. Now, there's a particular diagram that I drew. Having been a management consultant, I like to draw pictures, and so we'll put that also on the screen. And basically, what I've tried to map out is what I view is the dynamics of the physical market for silver. So you get a whole bunch of silver coming into the sector, mainly through the mining companies, but also through recycling. And recycling could account for about 20 to 25% of annual silver supply. So if there's any waste from industry or anything from the investment community that needs to be recycled and that to be remelted, that can be also part of this additional supply. And then you also have the demand element about who actually demands silver. And one thing that we can say that since this silver squeeze started in late January, we have started to see stresses across the global silver market in ways that really haven't happened before. So let me give you some examples. So on this diagram, I've got 5 stress points. So particularly in North America, retail dealerships have been effectively cleaned out. All of their inventory has been sold. What I can say about the Australian market is that in the first week of February, there was an uptick in sales, but it was fairly calm after that. There has been an uptick in sales in Europe as well as in Asia. And I do have some contacts in both markets, but the North American market really went crazy. In the last couple of weeks, we've started to hear a number of senior people in the silver industry say that the wholesale market, and the wholesale market is 1,000-ounce bars as opposed to smaller bars, which is the retail market. The 1,000-ounce bars, they're getting harder to get in terms of at the current price, and so that they're starting to run dry. In terms of the ETF, so the largest ETF is an ETF called SLV iShares. They actually had an inflow of so much money over 3 days in late January, early February, that they couldn't actually put all the silver in the vaults that they are legally required. So their prospectus says is once you invest in the trust, your shares are issued, and then a requisite amount of silver is put in the vault on the same day. And the volume of shares and money coming into SLV was so significant, they just couldn't match it. So in the middle of the night, what they did was they actually changed their legal documentation. They changed their prospectus without telling anyone. And they basically said to the market that there's going to be a mismatch between the shares on issue and in terms of the silver. And that was discovered by someone in the silver community. And that was a very big deal, because effectively that is the default. I mean, when you invest in a trust, under a legal document with a certain commitment, you expect that commitment to be followed through. And then when they don't tell you, but then they change their legal documentation and say, well, now there's going to be a mismatch between shares on issue and silver put in the vault, that's effectively breaking the commitment that was in the initial prospectus. And so we'll quickly go through that in a second. But then we also saw another stress point, which is the London market. So you and I, Martin, have talked about gold leasing, particularly in terms of the Reserve Bank of Australia. So the Reserve Bank has 99.9% of its gold in the Bank of England. And they have been leasing gold to the Perth Mint, and that's a big scandal that we revealed last year. And so there is a interest rate called in terms of what they call a sort of silver leasing rate for banks. And we'll put this graph up on the screen. And what we can show in the graph is that the cost of leasing. So typically, when someone wants to, when someone owns silver in London, and someone wants to lease it, the person who owns it typically pays, because if they don't lease it, if they don't lend it to someone and they don't pay, then it's actually a very expensive cost to actually store it and to warehouse it and to move it, etc. So typically the owner will pay someone else to take the silver off their hands. And because by that they're able to sort of save on a net basis in terms of these leasing and holding costs. But in the last 4 to 5 weeks, we've seen that leasing rates have actually gone through the roof, and that now if you own silver, the people who want to borrow the silver from you will actually pay you for the privilege of borrowing your silver, and that's a very unique market. So the physical market in silver in London, which is the largest market in the world for gold and silver, that's becoming very tight. And then on top of that, we're seeing a huge amount of delivery of silver being demanded at the COMEX. And so we've got about sort of 11 days into this March contract, and we've got about almost 49 million ounces of silver, which is standing for delivery. And so far from the data that I can sort of ascertain from the warehouse, so that they put up these daily warehouse spreadsheets, and it looks to me that only 12 million ounces have been delivered. So there seems to me they've still got a few more weeks to meet these delivery demands, but there's still a lot of silver to be had. And the question is, do they have that silver? So what we're seeing right across the physical market is a lot of demand, a lot of stress. And I should make the point, there's stress at the current price. Now, if the price starts to go up, no doubt there'll be people around the world who are willing to sell their silver at a higher price. But at the sort of current price now of $25, $26, $27 US an ounce, there's not a lot of silver to go around, and you're starting to see a whole bunch of players who are getting worried as to can they get enough silver to meet their legal obligations.
Yeah, very interesting. And John, the futures price for silver, so the contracts go out over the next few months and things. Is that still moving around a lot, or is it settled down? Because of course we've had a lot of volatility across many markets recently.
Yes. So now that so for those who are unfamiliar with how COMEX works is with silver in particular, there are certain months of the year that are up for delivery, so which is March, May, July, September, December, and then the alternative months they're basically for gold. So basically the futures prices now they're trading around the May contract, but now that we're in March, they are now in the mode of in terms of trying to deliver all the silver. So absolutely, there's still a lot of volatility, and one of the big scandals in this market is that you tend to see very similar patterns happen at very particular points of the day. So when New York open, when the New York market opens, when the New York market closes, you start to see the price start to go through a waterfall pattern, and it just goes through the floor. And a lot of those patterns are clearly not they're not sensible trading strategies, and there have been some problems with the American regulators in terms of coming to grips with what's really happening in terms of the silver market. So, people who have watched the movie The Big Short will probably remember that even with the rating agencies were not providing in terms of these subprime bonds. They weren't giving them the appropriate or the relevant credit rating. and the people sort of trying to regulate this whole industry were quite lax. And all of that sort of unraveled, and then we had the global financial crisis. So same sort of situation in Wall Street today, that a whole host of shenanigans are happening in the silver market, and the silver market's been these shenanigans have been happening since the 1970s, and there is a institutional resistance to actually come to grips with what's going on in the market and to actually apply the rule of law.
Funny that. Yeah, and there are some big players who operate within the markets, right? So you mentioned some of the dealers. A lot of those are the big international banks.
Yeah, totally. So we've got JP Morgan, HSBC, Citibank, Bank of America. So I think Scotiabank have just now left the market. But look at quite a few big banks in Asia, United States, and in terms of Europe. They are heavily involved in terms of the silver market as well as in the gold market, and they're the ones that have what they call concentrated short positions. So for every futures contract, you have someone who buys the contract, which is a long. You have someone who sells and who has a commitment to deliver. They're the shorts. And if you have a player on one side or the other that has too many contracts, then they can sort of manipulate the market in whatever the way that they wish for the market to go. And one of the criticisms of analysts who've been analyzing this market for quite a while is that you've got eight big bullion banks in particular who control like almost 50% of the market. And between those 8 banks, they can move the market whatever way they want. And to a large degree, that is how they've been able to suppress the price. And so if you remember back from our last show, when I said we have a price ceiling below equilibrium, well, how is it? So the price ceiling, if you look at it since, say, 2014, the price ceiling is probably sit around $30 an ounce. So it's struggling to get above $30 an ounce US. So why is that? Because these 8 banks with these concentrated short positions have the ability to move the market in a whole host of directions that they so wish.
Right, and I imagine that the other side of it, John, is if the market did move a long way from that, $30 or whatever it is, that would put huge pressure on their own balance sheets.
Correct. And I was going to say, I will come to that in just a second, because something really interesting happened last July in the silver market that I want to sort of explain to the audience. But before I do, I just want to bring up this quote on the screen, just so we can explain to people that when you have a legal entity like an ETF that have a legal commitment with their investors and they can no longer meet that commitment, so how do these defaults actually occur? So this is, let's put this on the screen, Martin. So this is the SLV. This is their change to their iShares Trust prospectus on the 8th of February. So this is not the full amendment, but this is a section of it. So quote, the demand for silver may temporarily exceed available supply that is acceptable for delivery to the trust, which may adversely affect an investment in the shares. To the extent that demand for silver exceeds the available supply at that time, authorized participants may not be able to readily acquire sufficient amounts of silver necessary for the creation of a basket. And for those who are unaware, a basket is just a large block of shares. It is possible that authorized participants may be unable to acquire sufficient silver that is acceptable for delivery to the trust for the issuance of new baskets due to a limited then available supply, coupled with a surge in demand for the shares. In such circumstances, the trust may suspend or restrict the issuance of baskets. So basically, there was a commitment that the more money that comes into the trust, there'll be an issue of shares or large blocks of shares, i.e. baskets, and requisite silver will be put into the vaults. Well, here's some legalese language to say, well, that may not occur in all circumstances. And obviously, without any warning, this just happened in the middle of the night, and some smart, clever people overseas found these changes and wrote a number of articles and they did a big expose. But this is the kind of thing that can happen when a Wall Street entity. So, and I should say that this SLV is managed by BlackRock, and the custodian, the organization responsible for putting the silver in and out of the vault, is JP Morgan. And so when they get caught out with a lack of silver, these sort of changes to their legal documentation is what typically happens.
Point there again is that it was done quietly. Few people noticed. You wonder how many other agreements are quietly changed, and perhaps people haven't detected those changes.
That is a great point, Martin. We see these shenanigans that happen all the time. Look, particularly for retail investors. I mean, and one of the things I continue to get a little bit nervous about is, when people invest in a whole host of very complex or exotic products or even asset classes in terms of some of these cryptocurrencies, to what extent that do people actually understand in terms of what the level of risk is? I mean, over the last couple of years, Martin, we've talked about bail-in, we've talked about, in some circumstances, about terms and conditions with deposit accounts and mortgage contracts, etc. So, we've delved into some of that area in the Australian context, but particularly if you're investing in overseas assets, particularly if you're an unsophisticated retail investor, to what extent have you actually gone through all the legal documentation to understand what's going on and what the risks are? And how aware are you when these documents change in the middle of the night?
Well, it's, I think, caveat emptor, people should be very cautious and, ask the hard questions, right? Because, of course, it is possible to end up with a contract that is effectively relatively meaningless, and you think you have access to physical silver when you don't.
Totally. Now, one thing, look, is, so you asked a question about, well, if the price comes to a point in which they can no longer deliver, the price has to run, and then the bullion banks, those who have the concentrated short position, they're the ones that take a loss on the balance sheet. So all I want to do is just, in terms of a final point, is put up a graph that clearly shows about what happened with the silver price last year. Now, the interesting thing is that July last year was the largest delivery month for silver in the history of the market. So I think they ended up delivering about 86 million ounces. And what happened was, in the first 2 weeks of July of the delivery month, the price did nothing. So in US dollar terms, it was flat, around $17.95 an ounce up to $18.05. And then from mid July to the end of the first week of August, so we're talking a 3-week period, the price went up 60%. So it went from $17.95 all the way up to about $29 an ounce. And so 60% in 3 weeks, that seems like a very dramatic move. So the reason why it moved in that fashion was because halfway through the month, the people required to deliver silver didn't have enough. They needed to let the price run, and the price was quite aggressive over that 3-week period. And in that interval, as the price was escalating, they were able to attract enough sellers into the market who were willing to sell physical silver, and those who were required to deliver got enough physical silver to deliver and obviously meet their contractual obligations. So there was a bit of a price ceiling last year. So probably from about 2014 all the way through to 2020, the price was stuck around $17 an ounce, or $17 to $18 an ounce, and then that price ceiling cracked last year when there was enough pressure applied to it, and then it ran up to 29, and then since then it's been bobbing about between 29 all the way down to 24. And now the question is that we have, with the silver squeeze movement, we have an enormous amount of pressure in the physical market right across the global supply chain. And the new question is that will this new pressure, as well as this significant amount of demand at the COMEX for the March contract, if it doesn't happen in the March contract over the next few weeks, where obviously attention will turn to the May contract when the next delivery month comes up, is will enough pressure be applied for the price to go even higher, above the $30, because they just can't get enough physical silver to meet their delivery obligations? And obviously, if that were to happen, again, the bullion banks who have these short positions, they would take some sort of loss, because they have these short contracts at particular price points, and that's obviously the essence of the silver squeeze. One of the latest articles I wrote was that sort of combines some of our discussion from the last show about the bond market crisis. What I am anticipating is that as the central banks have now had to intervene with more QE or yield curve control to control these bond yields, because the market, I expect, will view these moves as inflationary. And next week we'll see the US Federal Reserve, the FOMC meet. If there is some sort of announcement of additional stimulus, dare I say that that could lead to an increased demand for commodities across the board, including silver. And that could be the straw that breaks the camel's back in terms of this price ceiling. But we'll have to see. But for those who have been hearing about the silver squeeze and may have been watching some of this content on another channel, that effectively is the essence of what has been happening over the last 5 or 6 weeks. And we'll obviously have to see how the market progresses over the next few weeks and months.
Well, John, I appreciate that update. It's certainly important for people to understand the dynamics, the uncertainty, and those pinch points too, the particular dates when effectively, delivery is required or when they have to market, because those are going to be the critical points. And I think the other points you make quite clearly is the link to the bond markets and the risks there. So I think it's bubbling up.
Yeah, I think it's like I mean, there is definitely more volatility there because of all this, in terms of stimulus, and probably since we last recorded, Martin. I mean, the Congress has now passed a $1.9 trillion stimulus package. We now Biden is now focusing on his new $2 trillion climate change package, which is $2 trillion over 4 years. And the question keeps on coming up for these Americans is, well, who's going to keep on lending you money to finance all of these deficits? And that is definitely a question that the bond market will have to answer.
I agree. John, I appreciate your time today. We'll update to the audience again as things develop, and watch the skies, I think, is my recommendation.
Absolutely. Thanks, mate.
Thanks. Martin North, John Adams. In the interest of the people, we'll see you next time.